$1 million feels like safety until you ask the one question that actually matters: will it last? Today, I'll show you why that number might be a trap and what it really takes to retire with confidence. As someone who runs a retirement planning and tax preparation firm, I've worked with dozens of families in this exact scenario. From that experience, I can tell you $1 million might be enough, but only if you understand three key variables that determine the success or failure of your retirement. So in this video, we're walking through a real case study to find out if $1 million is truly enough to retire at 60. We'll explore the risks, the trade-offs, and ultimately, whether that nest egg will last. So I want to introduce you to John. John is 60 years old, and after decades of hard work, he's wondering if he's finally able to retire. John's dream in retirement is to travel the world and spend more quality time with his kids and grandkids. He's realized these are his prime years while he's still mobile, healthy, and energized, and he doesn't want to waste them. And this is what John's financial picture looks like. John has $1.3 million saved, $1 million is in a traditional IRA, $300,000 is in a taxable brokerage account, and he does not have any Roth dollars currently. His Social Security benefit at full retirement age will be $3,261 per month, and he owns his home free and clear in the state of Florida, and it's worth about $750,000. His current monthly budget is $5,500 after tax, and that includes $5,000 per year for travel. However, for the first 10 years of retirement, he wants to increase that travel budget by $10,000 a year to check off some bucket list trips. However, this is John's major concerns, right? John has officially crossed two major retirement milestones. First, he has a $1 million portfolio. And secondly, he has a $2 million total net worth when you include his paid off home. And so on paper, it feels like he should have the golden ticket. However, instead of feeling confident, he actually feels retirement has never been more out of reach. And the reason why is because John initially used the 4% rule as a benchmark. That gave him a gross income estimate of $52,000 per year, but he would actually need closer to $100,000 per year in gross portfolio withdrawals to fund his lifestyle, and that's closer to an 8% withdrawal rate, double what the so-called safe amount would allow him. In addition to this, most of his savings are in pre-tax accounts, meaning that taxes could eat away at his withdrawals, which might leave him short in the future or force him to scale back his lifestyle today. And with a strong history of longevity in his family, John is planning for a 35-year retirement all the way to age 95. So John's absolutely correct to have some of these concerns and to be asking the question, is $1 million going to be enough? And so you may be watching this video and thinking to yourself, wow, I'm struggling with the exact same questions as John is right now. Well, don't worry, because we're about to walk through John's plan and show you how we helped him make informed, confident, and responsible retirement decisions. Figuring out how all this applies to your specific situation can be overwhelming. And so if you want this kind of clarity for your own retirement plan, go ahead and click the link in the description of this video to learn more about what it looks like for us to work together. And so on to the actual numbers here with the case study. There are three key variables that we are going to want to look at and analyze using our financial planning software. And in today's video, we're going to use Income Lab, and we're going to evaluate spending strategy, investing strategy, and tax strategy. So when it comes to spending strategy, we use a method called risk-based guardrails. This is a slightly different approach than the typical guardrail strategy because it's not just withdrawal rate focused, it actually factors in longevity expectations, expected future cash flows, future changes in desired spending, and a few other factors. This approach will allow John to withdraw more in early retirement when it matters most, as long as he's willing to potentially reduce spending later on. And that is the ultimate concept of the guardrail strategy, is that we can increase income today if we're willing to make changes in the future if the situation warrants it. So what does this actually look like for John in John's exact situation? So if we take a look here at the actual guardrails visual in John's plan, what this is actually going to show us is that John can have a starting portfolio withdrawal amount of $7,370. And if his portfolio decreases in value to $973,000, which would represent a 25% portfolio decline, at that point, we would want to cut spending back by about 4%, which would leave John with a $7,000 per month withdrawal. These numbers here have been calculated to target a 20% chance of requiring a reduction in spending in the future. And so if we wanted to actually dial up spending today, we can actually do that. And when we say, all right, spending today is going to be $7,710 per month, we can also see that right here, our risk of having to make a downward spending adjustment goes up. And conversely, if we want to say, well, you know what, John's expenses are only going to be closer to $6,800 per month, and we're going to go to the other side of the spectrum on this illustration here, it's going to show that our risk of having to make a future reduction in spending goes down dramatically. And in this case, that number targets a only 1% chance or 1% risk of overspending in this case. And so we also then have to keep in mind when we dial back the amount of withdrawals we're taking from the portfolio, our risk of underspending also will increase. And so in this particular case for John, I might actually encourage John to keep a higher initial withdrawal rate and maybe offer to bring his kids and his grandkids along with him on his travels and use this extra income as a tool to elevate his travel experiences, elevate his family experience. And so this might sound kind of scary because isn't $7,400 per month about a 7% withdrawal rate? And the short answer is yes, it is. But the reason why this works is because this withdrawal rate is not forever. And so I want you to take a look at this cash flow chart here inside the software. And so as you can see, the first 10 years of retirement might seem very scary because we have nothing but our portfolio income to rely on here, and our withdrawal rates in this time period range from 7 to 9%. However, if we flash forward to age 70, right, two things are going to happen at this point in time. Right, number one is Social Security is going to turn on at John's age 70 because we're going to defer it for as long as we can to get that higher benefit because we're expecting a long lifespan for John. Secondly, is that the extra $10,000 per year in travel spending will also drop off here at age 70. And so we're actually going to see a much lower portfolio withdrawal rate starting at age 70, and it'll continue to decrease through his retirement down to about a 3 to 4% overall withdrawal rate. And so I think it's really helpful to kind of see how this looks big picture, both in the portfolio guardrails illustration and to see how this gets modeled out from a cash flow standpoint. But what actually does it look like in action in a year-to-year retirement? And what happens when things go sideways and markets go down? And so that's exactly what we're going to look at. And it's going to take us into our second key variable, which is our investing strategy. And so we're going to navigate over to the retirement stress test side of the planning software. And we're actually going to model out a worst case scenario today, where we're going to say John is going to retire in 2007, just before the financial crisis where stocks dropped 50%. And as you could see, we would actually have to make a spending adjustment, a downward spending adjustment represented by this red line here, only 2 years into retirement. And that would actually lead to about a $300 per month reduction in spending. However, when the markets are down 50% and we only have to cut back $300 a month, John and I agreed that he could probably make that work and that the $300 a month wouldn't have an overall dramatic impact on his ability to travel. And so all of his base expenses are still covered, and he might just have to change how he travels for a short period of time. And so, as you could see, as markets continue to recover and portfolio balances begin to rise again, we would actually see several spending increases in those remaining years. And so to give us something even more extreme than the financial crisis, let's actually take a look at the Great Depression, where markets went down 85%. And so in this case, we would actually see several changes in spending. Very early on, we're going to have an increase, immediately followed by 3 decreases in spending here, and then followed again by increases in spending when markets and portfolio balances increase. And so you'll see that this is because the guardrail strategy is working in action here. This is a dynamic strategy that changes as the situation changes, and that is designed to ultimately lead to better outcomes. And I would want you to keep in mind here that while decreases never sound like fun, even with 3 decreases in a row here, we're still at an income level that's on par with John's original desired spending budget, which would be $5,500 per month for his base living expenses and about $835 a month for extra travel spending. And so even in a really dramatic situation like this, like the Great Depression, this retirement strategy and this withdrawal strategy still works for John, where he's not going to be forced to go back to work. And so as these two examples illustrate, both portfolio size and market performance have a great impact on this withdrawal strategy, which is why choosing the right investment allocation and the right investment strategy is a key part of executing the strategy. And so if we're withdrawing 7% plus from our portfolio, you might say, hey, shouldn't that mean we need to invest more aggressively to keep up with how much we're spending? And I'd say we're on the right track with that question, but it might not be the right course of action to take in the situation. And the reason why is because if we looked at a 2008 style scenario, a portfolio that is too aggressive, let's say, for example, a 90-10 allocation, so 90% stock, 10% bond, it would actually trigger steeper spending adjustments earlier on in retirement. And it would actually lead John to spend less in the years that matter the most. And so if we look at this example where we compare a 60-40 portfolio to a 90-10 portfolio, we're going to find that this is going to lead John to spend about $9,000 per year less than he wanted to or otherwise could in the 60-40 portfolio. And that the spending amounts would not catch back up until his mid to late 70s, which is well after his desired travel years are over. Now, conversely, you may think, well, in that case, wouldn't a even more conservative allocation be better in this case? And to answer that, I'd say a conservative allocation can reduce the risk of poor market returns early on, but it may not keep up with inflation. And so the guardrail strategy will actually require us to find a sweet spot when it comes to choosing our asset allocation. And so the third key variable that will dictate the success of John's plan is how good of a job can we do of keeping John's hard-earned retirement savings away from Uncle Sam. Good tax planning is going to allow him to keep more of his money and ultimately spend more for himself. Now, there are several tax planning strategies that we're implementing with John, but I'm going to share with you the big one that moves the needle the most here in John's plan, which is going to be Roth conversions. So if we navigate over to the Tax Lab area of the software, we're going to find that we've already put in place here a Roth conversion selection that's going to have us convert up through the 12% ordinary income tax bracket. So if we look down here at the quick stats in the summary, we're going to see that this Roth conversion strategy, just converting up through the 12% ordinary income tax bracket, is going to save him hundreds of thousands of dollars in taxes. If John were to do nothing and spend his portfolio as is and spend down his taxable account first, then his traditional IRA money, and then lastly, tax-free would be Roth, but he doesn't have any Roth at the moment, he would actually spend $634,000 in taxes, right? That's $634,000 that's going to the government. However, by implementing this Roth conversion strategy, we can reduce that number down to $348,000, which is $285,000 in tax savings. And therefore, because money's not going to the government, it's actually going to increase his total net income by the same amount. And so ultimately, what we're doing here is we're choosing to level out John's tax bill by voluntarily paying tax at an advantageous rate earlier on in his retirement in order to avoid these really ugly years later on where we're paying $30,000, $40,000, $50,000 per year in taxes again at the very end of retirement. And so one last thing that I think is going to be really important for us to talk about when it comes to these Roth conversion strategies is that this, along with nearly every other tax strategy, is going to have some kind of break-even period. Because the trade-off is that we are deciding to pay more tax earlier on in retirement, and therefore John will have a smaller portfolio balance earlier on in retirement. However, that might be a worthwhile trade-off because we're going to pay substantially less taxes later on. And so I really like this chart that the software provides here because it models out when we expect the break-even period to occur for John, which will be in 2047. So still plenty of time left in his retirement. And it shows that the amount of taxes saved, or in comparison, is substantial. And so because the tax saving is substantial enough and the break-even time period is early enough, I think this is a very, very worthwhile strategy for John to implement. However, if markets don't cooperate with us, or if John does not live as long of a lifespan as we were hoping he would, the value of a Roth conversion strategy can be less and less and less. And so it's really important that we understand the risks of a Roth conversion strategy and we don't over-convert when we're trying to maximize our portfolio income. And so back to the main question, can John retire at 60 with $1.3 million? And the short answer is yes, but there are key trade-offs that we need to understand. First is that higher withdrawal rates early on let him enjoy his prime retirement years, but they also mean he might need to reduce spending later, especially if markets don't go his way. Secondly, is that a conservative portfolio can protect against early market declines, but might fall short during periods of high inflation and again potentially lead to spending cuts and lifestyle adjustments. Conversely, an aggressive portfolio might outpace inflation in those periods, but it can also create volatility that makes short-term spending harder to sustain. And lastly, that Roth conversions can be a very powerful tool to lower taxes and stretch John's savings even further. But if he doesn't live as long as planned, or if the market doesn't cooperate, it may extend his break-even period, or it's possible they may not actually pay off. So yes, John can retire now, but retiring with confidence isn't about hitting a magic number. It's about knowing the levers you can pull and building a plan that adapts with you. And so if after watching this video, you are tired of rules of thumb and want clarity around your specific retirement plan, click the link in the description box below. Thanks for watching.